On this month's market update, we have final 2025 NAR numbers. And as we step into 2026, we have a few small updates to share.
We'll also be discussing end-of-year data on employment statistics as well as inflation.
We'll also share with you the latest in regards to mortgage interest rates.
All that and more on this month's market update.
Welcome to this month's market update. Please don't forget to click like and subscribe to our channel. And with that, Ruben, happy 2026.
Yeah, happy New Year, Gabi. We've got a few things to talk about today, right? So we're going to kick it off. We're going to start with NAR figures. We've got final numbers for the last year. We also got final numbers for employment, and then we're going to talk a little bit about mortgage rates for our last section.
Yeah, some interesting topics that we get to discuss as we're wrapping up, the forecast from last year as well.
Just jumping into it, we got December numbers, we got final 2025 numbers. So we ended the year at 4.06 million sales for 2025, which happened to be the exact number of 2024 sales. So 0% increase in home sales last year on a national level, according to NAR so far. Prices did increase, but only by 1.7%. They ended the year at a median sales price of $414,000 for the U.S. You had 4.2 months supply of inventory. Pretty flat year, right? Like 2% appreciation across the board, and sales were pretty slow. And we know we had like a decent bit of regional variation too, right? And I will say the regional variation primarily is reflected in prices. So when you look at sales, they're actually tracked relatively close to the national level in the broad regions, but prices, there was quite a bit of variance. So in the Northeast, we saw 6% appreciation. In the Midwest, we saw 4.3% appreciation. In the South, only 1%. And in the West, NAR had it at negative 0.5%. So that's quite a bit of variance, with the gap being from 6%, prices going up 6% year over year to being down 0.5% year over year in another part of the country. So, we are seeing, I think, some convergence around some of those numbers now. The appreciation in the Northeast and Midwest slowed down compared to the previous year, but still outpacing the rest of the country. When we look at forecasts for this year, we're also seeing improvement, right?
Where do you anticipate we're going to see the strongest improvements?
We're projecting right now about 4.4 million home sales next year. So that's a little less than a 10% increase. We think improvements are going to be a little bit mixed. So a lot of it will probably be in those softer markets where we've seen a lot of inventory build up over the last year, but we're starting to see demand start to come back a little bit. So we're not anticipating any kind of like wild shifts, but we do think that in those places as demand improves, sales will start to improve as well. In the Northeast as well, we're probably going to continue to see a little bit more inventory in those areas, and we also should see demand improve there as well. So a little bit of upside really across the board, primarily reflecting improvements in mortgage rates as the year progresses.
And based on what you're describing, this is the reason why we anticipate that there will be more transactions this year as well. We've had the pinned up demand, right? We still have those first-time home buyers that have been waiting in some cases for years and years and years to be able to get into the market. So with slightly more inventory being available and the pinned up demand combined, we should anticipate having more sales this year.
Yeah, we think it's going to be relatively slow, and we'll dive in a little bit more into mortgage rates later. But the movement there we don't think is going to be dramatic, with a couple of potential caveats that could do some things there that are hard to anticipate. Mm-hmm. But overall, we're in a situation where the economy is feels a little bit shaky to a lot of people. So that's part of why we don't anticipate some kind of like pronounced surge in demand, right? We still have affordability issues. Prices didn't increase much, but they're still historically high. They've gone up close to 50% since like 2019. That matters, right?
It was also interesting to discover as we were wrapping up the year, labor data.
Talking about some of that shakiness in the economy,
right?
Capping off the year, we ended up adding 49,000 jobs a month. That's down from 168,000 jobs a month in 2024. Kind of healthy, normal economy, you're adding between 100 and 200,000 jobs a month. So it's a significant slowdown that we saw in 2025. The other thing that's a little bit concerning is almost all that growth is attributable to just a couple of sectors. The health services, so hospitals, healthcare providers, places like that were doing the majority of the hiring. The service industry as well, so restaurants, hotels, some of that, which could slow down a bit this year. So, but if you don't include those industries, job growth went backwards in a lot of places. That's something we're keeping our eye on. It obviously affects demand for housing because as people become shakier about their jobs, they get into situations where there's caveats on their buying, right? Even if I'm a buyer now, I'm saying we need to buy something we can afford on just one of our salaries potentially, right?
As we say in the real estate industry, right, you are looking for buyers who are ready, willing, and able. And what you're describing means that some buyers out there may no longer be able because of the uncertainty that they may have around their own jobs.
Yeah, we're going to see buyers with more concerns, right? If this doesn't reverse trends, which it could as the year goes forward, we don't know for sure. But as things stand, you'll probably encounter more buyers that are trying to make sure they can afford the house they're buying on the long term with the caveat of like, what if one of us loses our jobs?
Absolutely. But I also think this is a really great opportunity for real estate professionals to get ahead of those objections, because if we know that economically the signs are pointing towards continued uncertainty, then we know how to have the right conversations to simply remind a potential home buyer that a mortgage is forced savings. And in fact, it's a forced retirement vehicle for them to be able to take advantage of. So if we know that those mortgage rates, and I know we'll talk about it, are going to remain relatively flat, then why should we wait to begin the forced retirement savings for our own families?
Right. Inflation numbers came in relatively decent end of the year. CPI was at 2.7% minus food and gas, basically food and energy prices. We were at 2.6%. Those are definitely moving to some extent toward the Federal Reserve's target rate, which is probably, we saw if the Fed cut rates at the last meeting.
Yep.
We don't anticipate they're going to cut rates at the end of January, though. Right now, they're sort of on a anticipated kind of pause in rate cuts. We think we're probably going to get one cut by June, but that's about it right now when you look at how markets anticipate the Fed acting over the next 6 months.
What would be the reason to have one more cut before June based on the economic signs?
The reason would be continued kind of deterioration in the labor market. So as they look at that, unemployment's still at a pretty good number, but they are watching things like after this last month of data, job openings were higher than unemployed people for the first time in quite a while. Like we talked, we were only adding 50,000 jobs a month over the last year. And the last couple of months in particular have been relatively slow, and a few more were revised down in this last release. So that's one reason that's kind of toward cutting rates, right? That we need some stimulus to maintain the state the labor market's in. The other one would be that inflation's starting to kind of come in line, but there's still pieces of inflation, I think, that we're concerned about. So food prices were up 3% year over year. I think December showed some of the highest jumps in grocery prices in like the last couple of years. Electricity's up almost 7% year over year. Probably some of that, especially in certain areas of the country, is related to some of the data center construction. You can actually see it track with where these things are built, and energy prices starting to go up because you're adding so much demand to compete with consumers, basically. And then heating gas, so natural gas, utility gas is up about 11%, which if you're in the Midwest right now and it's 6 degrees outside, it's impacting your budget, right? So there's different pieces of inflation that are still concerning. One interesting fact, though, is that we talked about the price of shelter in that for a long time being one of the things that were driving the numbers up for several years, coming out of when we peaked at like 9% a few years back. That's come down to basically normal now. Because home prices have been going backwards in some markets, and the median home price is only up, about 2% last year. That piece has kind of fallen out of what's driving inflation right now. So now it's the other stuff, the smaller things that we're buying on a day-to-day basis that are actually driving what's there and keeping it covering near 3%.
Mm-hmm. Which is, in a sense, also not helping those who are thinking about making a home purchase, because you're looking at those bills. And when you're starting to think about a monthly payment that might potentially be slightly larger than the apartment rent that you've had in the past, those are now important factors to consider as you're thinking about the family budget for 2026.
Yeah, I mean, we know those are a lot of the buyers that are not coming into the market right now. Your first-time buyers, your marginal buyers, people who are on the edge of affordability, right?
Yeah.
People who could make that decision, but it might be a stretch. Like they're the wait-and-see buyers potentially now. Plus people who are still sitting on relatively low interest rates,
Yes,
right? Like
yeah.
there's still plenty of people out there who have interest rates between 3 and 5% that aren't going to be super excited about jumping into a 6% mortgage.
Yeah. There's some potentially good news, at least for those who purchased the last 30 days as it comes to mortgage rates, though.
Yeah, so we've seen rates start to trend down, right? So, we've moved off of, last year at one point we were sitting at like 7%. Right now, we're moving back towards 6%. We're at about 6.1 right now. Last month, when we sat down here, we were about 6.25. So things are trending in a good direction. As we head into next year, there's kind of mixed forecasting on where mortgage rates are going to go. And a lot of it revolves around political pieces, around what's going on with the Federal Reserve, both the decisions they're going to make and decisions about who's going to be in leadership positions in the Federal Reserve. Those are all right now potentially weighing on long-term interest rates and therefore mortgage rates. Broadly speaking, we think they're going to get below 6% potentially at the end of this year. The question is it sooner or later? And just how far below 6%, right? I think the last Fannie Mae forecast I saw put them at 5.9% at the end of the year. So that's only 20 basis point movement, right, from where we are now to the end of the year. Some of the MBA forecasts have had rates actually higher than where they are now. So we'll have to see what balances things out as we go forward with anticipation around future inflation, around future movements in mortgage rates to have to counteract what's going on with the economy, things like that. So I would anticipate volatility to continue in mortgage rates, but I think we're going to also continue to see this kind of broader downward trend and probably kind of a flattening out in where rates are this year.
And if we bring it back to what does this mean for the consumer, it actually means very little. As long as you are continuing to look for a home because you are motivated, ready, willing, and able, it may mean that when you find the right property, pull the trigger, because we're not going to start or to continue to see any mortgage rates that will be vastly below 6% this year.
I know, it feels weird to be in 2026, right? But yeah, as we're looking forward, there's also some news stories out there that are bouncing around. But right now, so far, it's just suggestions. We haven't seen anything concrete. We've seen suggestions around GSEs purchasing mortgage-backed securities, which does have potential to bump rates down. But I think it would mostly be a temporary bump unless they've managed to put something together that allows them to have the kind of cash they need to sustainably be buying rates down. And there's more what we call moral hazard baked into some of that as we get down the road, but none of it's on paper yet, so I'm not going to speculate. But I will say that, they're talking about $200 billion that could be used to purchase mortgage-backed securities. But when you go back, the Fed was at one point buying $80 billion every single month to push those rates down. So it gives you an idea of like the required scale to really influence mortgage rates through that venue. So
does the government really have an appetite to add $200 billion onto their balance sheet as well?
Yeah, and particularly the GSEs, right? Because they're basically run like private companies that are expected to some extent to be profitable, and they have to figure out if they can sustain the cash flow to do that. So we'll see how that evolves. We've also seen some speculation around policy, things like using 401ks with down payment. I think it's important to note right now, all this is just suggestions, right? Like things have to go there. A lot of these things will have to go through either agencies or even through Congress to get approved. So, while we're hearing about them, I think it's important to pay attention, but also important to note that, nothing's been done yet. Essentially, right? We need to wait and see what actually gets put and set down in stone before we can really analyze things.
Well, and you make a really good point for our listeners as well, because as we're hearing the speculations and something that is just now beginning to get sensationalized, based on initial conversations, it's important because our consumers are hearing the same information as we are hearing as real estate professionals, to remind the audience what the time frame and the process would be for any of the ideas to actually take shape in a legislative form. It could be years until something like this comes about, and it should not prevent someone to wait if they have a real estate need in 2026.
Yeah, and I think it's important to just pay attention, right? Like we're in an election year. Everyone's going to be talking about this. It's good that home affordability is one of the topics of conversation. We'll have to see what solutions aren't implemented, but I think it's a good thing that people are talking about our industry, and I think it's a good thing that we can acknowledge that something needs to change, right, for home affordability to improve.
Absolutely. We'll be eager to see how the spring market begins to take shape, as there is always energy that enters the market. And of course, we'll keep you all posted as we have new data coming in next month.
Yeah, for sure.
It'll be interesting to share some updates as we're also stepping into our national convention here at Keller Williams Realty Family Reunion in Atlanta next month.
Yeah, we'll be on stage in Atlanta with our chairman of the board, Gary Keller, and Jason and Cody and all the rest of our executives will be sharing their thoughts on how the year's going to evolve next year as far as this housing market and, everything else that Keller Williams is going to be up to. So I think it's going to be an exciting time.
We look forward to having you with us next month. And remember, if you are watching on our YouTube channel, please be sure to drop comments or ask questions about previous or future episodes of things that we should be discussing. We look forward to having you join us.
Until then.